Good afternoon. Welcome to the Oklahoma City Post-Employment Benefits Trust meeting for August 13th, 2025. I'd like to call it to order. We have item number 2 is approval of the minutes. I think we can approve these all together, can we? Both A and B, May 14th and May 29th. So I will consider the motion. Item 2 passes unanimously. We have item 3, items for individual consideration. Item 3A is receive the quarterly investment report for the period ending June 30, 2025. Jason?
Good afternoon, everyone. So we have the June 30 report, and then we'll just update a little bit on July. I'm happy to report it's been a very good first half of the year, perhaps a bit surprising at where we were coming into the year with how expensive U.S. large cap stocks were. A lot of noise around policy, particularly tariffs. We've seen U.S. stocks have more than a correction, dip into a bear market down 20%, U.S. large and small cap, but where we sit today and as yesterday and again today, new records on the S&P 500 and the NASDAQ. And that's been helped by non-U.S. stocks, which have done very well this year as the dollar has declined, an area that hasn't been quite as beneficial over the last few years, and even your fixed income. So I'll touch on a little bit more detail on the markets to show you a couple slides here. So as I mentioned, if we look at year to date, this is through the first 6 months of the year. Non-U.S. stocks as represented by the EAFE index, this is non-U.S. developed markets, up almost 19.5% through June, whereas the S&P is up 6% year to date through June. That's a big change with non-U.S. leading the way.
So Jason, how much would you say of that 19 is related to just the dollar?
It's about 40%.
40% of it's the dollar and 40, okay. So the businesses are still profitable. They're doing
businesses are profitable. And even if we look back when non-U.S. was lagging the U.S. by quite a bit over the last decade, in local currency, those companies had been doing well, but you were hurt as a dollar-based investor when you converted that back into dollars because the dollar was so strong. So that diversification is helping now. Emerging markets, similar, up 15.25%. The one laggard has been small cap. We've seen in the last really 2 days, yesterday and today, small cap has rallied over 4% with expectations that we might see a rate decrease in September. The Fed dot plot and most market observers are thinking, based on the data yesterday, that there could be a reduction in rates, which helps small cap a little bit. One of the other things we've seen in small cap over really the last couple of years is when the index rallies, there's a lot of lower quality companies in that small cap index. Over about 50% of the companies in the Russell 2000 are considered non-earners, so they don't have positive earnings. Oftentimes we don't see active managers, stock pickers, owning those companies because they don't have sustained earnings. There's a lot of biotech, healthcare, small healthcare companies in that area. And then an event occurs that will drive their price up pretty rapidly. Think back around the meme stocks coming out of the COVID crisis. We saw a lot of small cap companies rally. So while small cap hasn't necessarily done well, as it rallies like it has the last few days, we may not see our active managers keeping up. That's not to say that they're not adding incremental return in the portfolio. The other thing that has been beneficial is fixed income. While much more muted in terms of absolute return compared to equities, the aggregate or U.S. investment grade bonds up 4% year to date through June and up 6% over the last year. If you think about really since the inception of this trust, going back to 2008, 2009. Fixed income has been really just there to provide some ballast and principal protection when you have big declines in the markets. Now it's actually adding a bit of return, where yields are much higher than they've been over the last decade. The 10-year Treasury at about 4.25%, getting paid a little bit more to take credit risk and a little bit more duration risk. As we move to your portfolio, just skip over all these market pages. This is just a quick snapshot looking at your portfolio versus objectives. These objectives are defined in your investment policy statement. The first three are more market-based, so you have a CPI objective. You want to outperform the performance over 5 and 10-year periods to exceed inflation. Plus 4%. So inflation had been pretty low for a good part of the decade, then it bumped up. Now the 5-year inflation plus 4% is about 8.75%. Over 10 years, it's 7%. Your portfolio has generated almost an 11% return over 5 years and almost a 9% return over 10 years. So exceeding inflation as you're trying to outpace the increase in cost of the other post-employment benefits that you're obligated to pay over time. The assumed rate of return, this is more of a pension function, but you do have that in how you discount your liabilities from an accounting standpoint. It's at 7.5. You've exceeded that measure quite nicely. And then exceeding just what the risk-free rate is or cash over that time. And this portfolio has done that by a significant amount. The last one is a policy benchmark, so this would reflect your asset allocation. At the bottom in the footnote, you see what the policy is effective June of 2025. We made some modifications to this to more accurately reflect what your actual allocation is. So 35% the S&P 500, 15% Russell 2000, which is small cap, 20% ACWI ex-US, which is non-US, and then 30% Bloomberg aggregate, or fixed income. Prior to that, going back to the inception of this trust, it was, I believe, and I made a note to add this to this page, I think it was 60% S&P 500, 10% non-US or ACWI, and 30% Bloomberg Ag. Your actual implementation, while you didn't have dedicated small cap, you did have mid cap, and over that decade, large cap, and particularly the Mag 7 over the last few years, have been the best performing asset class. So on a relative basis, relative to the policy index, that's why the portfolio trailed a little bit. Your portfolio didn't mirror that policy index that was heavily weighted to US large cap. Nonetheless, very strong returns. When we look at another comparison here in a page or two relative to other public funds, many of which are pensions but have long-term liabilities like this portfolio, it's actually been a big positive having an overweight, if you will, to US large cap relative to peers. This page just looks at the target allocation versus where we are today. This target allocation was tweaked a little bit over the last year. I'd say tweaked in that we defined more precisely what is in the portfolio outside of large cap. Before you just had US equity and non-US equity. Now we've defined within US how much is in large and how much is in small to mid cap. So we have a target of 35% to large cap, which is 100% implemented passively via the Fidelity Fund, and then 15% to US small cap. As of June now, you did have 2 mid-cap strategies. We've eliminated those dedicated mid-cap strategies, or you had one passive mid-cap and one active mid-cap value. We've eliminated those 2 and added a small to mid-cap value to complement Stevens, which is a small to mid-cap growth fund that you've had in the portfolio for some time. The growth and value pieces, Stevens and Kennedy are intended to be equal weighted. And then on the non-US equity side, you have a 20% target. We did bump that up from 10 to 20 as we reviewed asset allocation. So not our US came down a little bit, and we bumped up non-US from 10 to 20. So you were at 80% US, I'm sorry, previously. Within the non-US component, you had a value manager only in Causeway. We've reduced that a little bit and added Chautauqua on the growth side. And those decisions were made at the last meeting. That's all been implemented, and the portfolio rebalanced. We had to take some from a few managers, move a little bit of money around. But as you'll see, the actual allocations are pretty close to targets, pretty much right on the target, and then a little bit in cash. From a dollar standpoint, I always think this is probably the most useful thing, as we talk a lot about percentages and relative performance, but obviously you spend dollars. This trust was created at a good time. If you just think about the last 10 years, I know that this started at 0, I want to say, and I think that's on the next page, in 2009. It was a challenging time. You're beginning this right at coming out of the financial crisis, but look how far you've come. And from there, I know you were consistent in funding, and then the markets have helped. Ending June at a little under 120 million. At the end of July, I think you're at 121 million. So that 10-year return on investment, back to this page, so 10 years ago, so this would have been 2015, you were up to 35.3 million. You've had net additions, so this is money that you've put in, the city or participants have put in, less money going out to pay benefits. It's a positive cash flow. That's, typically in more mature systems, if we're looking at like the employees' retirement system, the pension plan, that's going to be a negative number because it's a more mature system where you're paying out more in benefits. This, you're still growing the assets, and then you're paying a little as you go on the benefit side, not coming out of the trust, but that positive number. But the 64.1 million, that's what the portfolio has earned from an investment earnings over that 10-year period. So pretty significant growth over that 10-year period. Finally, just looking at, again, putting this a little more comparison and comparing as of a point in time. This is as of the end of June, looking back over these various time periods, all ending June. But these numbers you see here in the middle of the page, 30, 48, 8, 3, 5, 6, 5. Those are the peer group rankings. And we're comparing this portfolio to other public, and it's defined benefit plans because it's just more robust, but you're similarly allocated, of a similar size, 50 million to 250 million. These numbers that are less than 10, that's good. That means you're outperforming over 90% of other plans in that universe. Now, what I would say is that a lot of that, most of that has to do with the weighting to U.S. large cap. Over that period, the more you had in U.S. large cap, the better you're going to look. So that was a good thing. I know we've tweaked the portfolio a little bit as where we sat at the beginning of the year based on our capital market assumptions. U.S. large cap stocks do look a little expensive compared to other areas of the market. Generally, over longer periods of time, we will start to see that ebb and flow. We've seen that a bit this year with non-U.S. Outperforming. But certainly a pat on the back. You've done very well on a performance basis. From the individual manager standpoint, won't touch on this too much. Everything is, we've got a couple of new managers. Your existing managers, no issues. Large cap, we're 100% passively allocated to large cap U.S. stocks. So it's a very It's challenging asset class for active managers to outperform because the market's very efficient. We can see the index, or the passive index, is in the top third of the peer group. And this is over 3 years. If we looked out over 10 years, it's going to look the same. The index is outperforming 70% of active managers. So we typically like to be passive there. Within small cap, now we have 2 managers, Stephens and Kennedy. Stephens, long-term, you've had them going back to 2012. That's what the number in parentheses is, when their inception date in your portfolio. Over that 10 years, they've outperformed the benchmark net of fees by about 130 basis points. So that's very good. And that's ranking in the top, above half of the small cap peer group. So we're pleased with that. Kennedy, we just funded them. Long-term track record has been very good. You're not seeing any numbers there because we're only showing your returns in this report. On the non-U.S. side, Causeway and Chautauqua now. Causeway you've had going back to 2014. They're a value-oriented manager, tend to be more in the larger cap area of non-U.S. markets, but focusing on more value-oriented companies. The last few years they've done very well. You'll see like the 5-year number, almost 16%, about almost 4.8% above the benchmark. And relative to other value managers, they're outperforming 90%, and over 10 years, outperforming 80% of managers. Chautauqua, again, a new manager, growth-oriented, run a fairly concentrated non-U.S. equity growth strategy. Their long-term track record is very good. You're not seeing any numbers here because you don't have any performance in that strategy just yet. It was funded in July. On the fixed income side, we did make some changes over the last year. We eliminated dedicated high yield manager and the active duration manager, which was Hoisington, which is really long duration. It was really a play on rates, direction of rates. Both of these strategies, DoubleLine and Loomis, have a lot of flexibility. They can invest in high yield. They can invest in non-dollar or non-U.S. government securities. They can invest a good portion outside of the investment grade bond universe when they see value to do that, to take on risk. Both of them right now still look pretty core-like. They're primarily investment grade because spreads aren't very wide, so you're not getting compensated a lot to go out too far into high yield. But on a relative basis, relative to the aggregate, which is the benchmark that we compare to, that's your opportunity set, both have added quite a bit of value. On a 5-year basis, 50 basis points doesn't seem like a lot, but the benchmark's down 73 basis points. So they protected over that 5-year period. The peer groups here, these are pretty wide and kind of a mishmash. I'm not too concerned about these peer group rankings. What the underlying managers within these peer groups are doing are very different. We have DoubleLine in a Core Plus universe and Loomis in an unconstrained. It's slight variations of the same theme. Both of these managers we have a lot of conviction in, and they've done well. So all in all, strong report. Just quickly, and I don't know if I can switch the. I'll just switch to the July report real quick. Whoops. Asset allocation remains in line with targets. You'll see a positive month of July, up 98 basis points. The market value went up to 121 million. Still very strong absolute returns, 1, 3, 5, and 10 years. The relative return to the policy index, it's the same issue I just described. A lot more large cap in the policy index than what you actually had from an implementation standpoint. So I touched on the changes over the last year. You know, just had some notes here. We started working with you, I think it was about this time last year, Made some modifications to the policy index, made some changes to the fixed income portfolio allocation, got rid of a couple managers, narrowed down that, got rid of the mid-cap managers, added a small cap manager to provide growth and value balance, also added a growth non-US equity manager to provide balance. The other thing, just as a reminder, negotiated a new fee schedule with the custodian that saved about $26,500 a year. And I know you're renewing our contract, but that's a little bit more than 50% of our fee in savings that we negotiated. So done a lot. Probably won't be a lot of activity other than monitoring now for the next, hopefully, for the next little while. But any questions?
Everybody looks at me. No, I have none.
Okay.
No questions then. All right, then we'll go ahead and consider item 3A, and then we'll do 3B separately. A motion and a second. Record your vote. Passes unanimously. Now we'll consider item 3B, which are the monthly investment reports for May, June, and July. It also passes unanimously. Now we're at item 3C, is renewal number 4 of agreement with Nyhart for actuarial services with an estimated cost of $21,000 back to retroactive back to July 1st, 2025 through June 30, 2026. This is the 4th of our 5 option renewals. I'll consider a motion. Passes unanimously. Now we're to item 3D, amendment number 3, restated audit contract with Allens Gibbs Hulick, LC, to include audit services for fiscal year 24-25 with an estimated cost of $27,604. It's a 1-year extension with an increase of about $1,300. I'll entertain a motion for this item. Passes unanimously. Now we're at item 3E, is renewal number 1, agreement of Asset Consulting Group, LLC, for investment consulting, estimated cost of $45,000 for August 12th, 2025 through August 11th, 2026. And this will be the first of 4 option renewals. Passes unanimously. Now we're at item 3F, as authorized travel expenses for Trustee Berry to attend the Oklahoma Public Fund Trustee Education Conference. Passes unanimously. Now we're to item 3G, which is to ratify claims from April 30th, 2025 to July 29th, 2025. And does anybody have any questions regarding those? All right, then we'll entertain our motions. Motion second. Record your votes. Passes unanimously. Now we're to item 4, comments from trustees. Neil? Any over here? All right. I think, is this your first one, LaShawn? It's your second one, okay. All right. I must have been gone the last one.
You were here.
I was?
She's sitting here.
Oh, okay. Slept since then, so, well, good. Glad to have everybody here today. Staff, do you have anything? Any interested parties? Brett? All right. Seeing none, we are at item 5 at adjournment here at 3:24 p.m. Thank you.